Hello, very good morning to all, and welcome to today's Daily Dose of Market Insights. I'm Kelvin here again. Very good morning. Today will be Wednesday, the 7th of August, 2024. So as usual, before we start our daily Dose of Market Insights for today, let's have a quick look at the disclaimer slides first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or recommendation to sell, to buy, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right. Give me a minute. It seems to me that there is no sound, so hopefully, one second, let me do a mic check again. Mic test 1, 2, 3. 1 second. Let me restart my audio for a while. It seems to me that the sound is not working. Right, let me do a check again. All right, mic test 1, 2, 3. Test 1, 2, 3. Okay, good. I think it's all good. Sorry for a bit of hiccups just now. Maybe there's a slight sound error or something like that. Perhaps it's midweek over here. All right. So before we start our the usual intraday technical outlook on the major cross asset classes, let us have a recap what has taken shape yesterday in terms of news flow and as well as the respective cross asset classes intraday performance. So we know that yesterday we see a rebound in the major stock indices, spreading all the way from Asia to Europe and to the major US stock indices as well. So what we could see over here on our screen, all the 4 major US benchmark indices all ended in the green, almost across the board, close to 1% gain on the average. So the SPX and the Nasdaq 100 gained by 1% each. The Dow Jones Industrial Average positive 0.76%, and the outperformer is the Russell 2000 that is up positive 1.23%. And those who actually followed our daily dose yesterday, we do mention that yesterday I highlight that some key positive element, we call it the key bullish reversal day, that has taken shape on financial instrument that causes the last 3 weeks, or I will put it away, causes the last 3 days of onslaught that is related to the dramatic risk of across the board. That means we start to see a rampant risk off behavior has started to shape that bullish key reversal candlestick on yesterday. That means i.e. the Aussie dollar, the dollar yen, the Nasdaq 100, and as well as the West Texas crude oil. So that actually gave credence to yesterday's so-called rebound in this aspect of negating or offsetting the last 2 to 3 days of risk off episodes. So those who actually followed my daily dose yesterday, but those who do not, you can actually have a quick recap on how I actually identified such potential key bullish reversal day, and I explained the rationale behind it and its intermarket correlation or intermarkets dynamics in terms of the interrelation with the other cross asset classes in yesterday's daily dose, which I released on the YouTube channel or in the Asia Pacific YouTube channel, which you could actually take a look at it as well. All right, so what's interesting over here is yesterday we also do have the RBA meeting. So I do mention yesterday as well, the RBA meeting could be also a potential relief to the previous 3 to 4 weeks of Aussie dollar downturn, which indeed it came as expected, and managed to see the Aussie dollar bouncing off from a key medium-term pivotal support level. What is this level? Later I'll highlight again during the intraday technical outlook. So on a news flow perspective, what surprised me as well is that the RBA governor continues to prefer to take on a rather lukewarm, hawkish stance from a Australian point of view. And why do I say so? If you look at the rest of the other global major economy across the globe, ranging from we're talking about Europe, UK, US, with the exceptional case of Japan, all of them are in the mode of kicking start or have already kickstart their interest rate cut cycle. But whereas for RBA, they decided to push back against near-term rate cut and keep stressing on inflation risk. All right, and she did mention over here is that and even during yesterday meeting, there was a debate among the officials to even consider a hike. And during the press conference, the governor, which is this late Michelle Bullock, mentioned that the door is not even closing on a tightening basis. And yesterday, they also released their latest inflation forecast. It's something like the dot plot that we actually tend to actually focus on from a US Federal Reserve perspective. So Australia forecast, latest forecast on their interest, pardon me, Australia forecast latest on their so-called give me a minute, let me put it back again. Okay, where was it? Yeah, Australia latest inflation forecast done by the RBA. All right. Okay, 1 second, let me call it back up again. Okay, I think I accidentally so-called remove it. Okay, I want to share with you something. Okay, let me open up again. RBA. Okay, good. Okay, my apologies, but just now I opened that particular page. I accidentally removed it because I want to share with you their latest so-called the inflation forecast. Okay, where is it? Okay. Okay, not here. Yeah, this is the one. Okay. Okay, all the way down. Yes, this is the one. Okay, so this is the latest inflation forecast that was released yesterday during yesterday's we call it monetary policy meeting as well by RBA. So they were actually released every 3 months. So I could see that if you look at the concentrated on the trim mean inflation, so this one is actually the core inflation that is excluding those volatile items like energy and food. Okay, those at the bottom it was the previous one, the previous forecast. So you look at for December, means by the end of December, they are looking at a incremental increase of 1 basis point from 3.4% to 3.5%. And what they're actually expecting is to remain at the upper limit of 3% even by the mid-year of June 2025, and slightly increase by 1 basis point from 2.8% that was previously forecast to 2.9% by the end of December 2025. So overall, what you could see over here is this latest set of inflation forecasts is indicating that RBA officials do not have a strong view that inflation trend is on a tipping point of a deceleration path in Australia. So that means, i.e., yesterday's view itself is more like a hawkish hold instead, with some hawkish vibe that's still being peppered into the RBA kind of way of thoughts at this point in time, due to also be reinforced by the press conference of Governor Bullock as well. And importantly, what markets is actually looking at in terms of the so-called the RBA rate tracker. This I shared with you all yesterday. So for those who missed yesterday's daily dose of market insight, this is something like a CME Fed Watch tool, but compiled by the ASX, the Australian Stock Exchange. So you just Google ASX RBA rate tracker. They will give you end of the day data of what market is pricing in on the expectation of RBA rate hike or rate cut as implied by the 30-day Australia interest rate futures market. But this one is not really that real time because it only produces it by the end of the day. So the latest data only come out around Singapore time, let's say between 6 p.m. to 7 p.m. So what you could see that this is based on market close as of 6th of August. So we know that the Australia benchmark official cash rate is at 4.35%, no cut or no hike yesterday, it maintained the same. And this is the implied 30-day, based on the implied 30-day yield on the various contracts on the 30-day interbank cash rate futures contracts. It's an implied yield curve. So I could see over here is that this August, so in September, is still at 4.315%. In October, 4.29%. So it's almost unchanged, almost the same as the cash rate, the official cash rate of 4.35%. So every time the Australia Central Bank will tend to do incremental either a 25 basis to 30 basis point cut or hike in every potential move based on their past action. So you look at the November one, it's still at 4.195%, or put it away at 4.25%. So previously, in the previous day before the RBA decision yesterday, it was quoting at 4.09%, roughly about pricing in a 20 basis point cut by RBA in November 2024. So based on yesterday's RBA rather hawkish hold stance, this future potential interest rate cut by RBA has started to price out down the road. So right now, the more conservative pricing will be at around January next year at 4.10, the implier by 4.10, and February next year at 4.04. Okay, so now market is now pushing back the first interest rate cut by RBA to come in either in January 2025 or the February 2025 meeting. So what we could see over here is that this dialing down of interest rate cut by RBA in terms of the timing may support at least a short-term, we call it a bullish bias on the Australia dollar against the USD. But overall, from a medium-term perspective, the Aussie dollar is still trading within a trend, a wide range between the Australia dollar and the US dollar. So later I'll share with you all the chart of the Aussie dollar once I touch on the intraday technical outlook session. All right, so these are the key we call it events that has taken shape yesterday. Okay, so now as well as their impact of their so-called movement in the markets. So right now let us now take a look at the fundamentals and as well as the intermarket dynamics. All right, so now starting with the US Treasury, okay, give me a minute, yield first. All right, okay, so we know that in the last few days or few 3 to 4 sessions ago, starting on last Wednesday, we know that there is a push down in the US 2-year Treasury yield. Okay, this is the US 2-year Treasury yield. So a push down in the US 2-year Treasury yield implies that market has started to assign a high probability of the start of an interest rate cut cycle in US. Okay, this everyone is actually aware of for those who actually follow my daily dose of market insights. But however, if the fall of this US 2-year Treasury yield gets too steep, that actually encourages risk-off behavior. Why? Because it implies that the US Federal Reserve is behind the curve in starting an interest rate cut to prevent a hard landing scenario in US. That means now it comes to the point that is we'll answer it from a different context. A push down in US 2-year Treasury yield is good. Why? Because it adds on additional liquidity into the financial system. That means it should be encouraging risk-on behavior. But if a fall that is too dramatic in terms of magnitude and timing, it's not good for the financial market. Why? Because it implies that the Fed is late behind the curve in cutting interest rate, and perhaps there is something in the financial market or in the economy that is so bad or deteriorate that could create a cascading negative impact across the risk asset classes. That's why we started to see that dramatic risk-off behavior in the last 3 to 4 days. All right, so what's interesting over here is that I do highlight a key support level to watch at the 2-year Treasury yield, which is the quite a long-term pivotal support at 3.63%, which is this swing low area of 20th of March and 5th of May. And this dramatic fall over here, pump, it came down and it also formed a key reversal candlestick on end of the Monday US session, in line with the bullish key reversal candlestick on that risk asset classes that kickstart this domino effect of this risk off behavior in the last 3 to 4 days. The Nasdaq 100, the Nikkei 225, Aussie dollar is one of them as well, and as well as the West Texas crude oil. So what it means over here is that at this point in time, there is what I call a potential normalization in this steep fall of the US 2-year Treasury yield. That means there could be a mean reversion rebound, bringing back up to 4.12% and 4.42%. So this push up over here, it doesn't mean that we start to see a squeeze in the liquidity system. However, this push up means that the previous 3 to 4 bouts of risk off scenario starts to get abated, and market starts to actually reaccess the current so-called hard landing scenario in the US, and that could this further push up in the US 2-year Treasury yield at this point in time, in this current context, is more likely to be positive for risk asset classes. That means, i.e., further support this ongoing rebound phase that we highlighted yesterday for the major US stock indices, and we start to see the dollar, we call it weakness against the yen and against the Swiss franc. Those are two safe haven currencies showing signs of rebound back again, and the previous weakness on the commodities related currency like the Aussie, the CAD and the Aussie also impact the Kiwi, start shaping signs of rebound against the dollar in line with the rebound of the major US stock indices. So this is something to highlight, and what we could see is pretty much evident as well on the 5-day rolling performance chart of the dollar against the major currency as of today we are speaking. So previously, the last 3 days or 4 days or so, we do have a K-shaped performance where at the top the dollar performs strongly against the commodity related currency, the Aussie, the CAD and the Kiwi, but underperform against the safe haven currency like the yen and as well as the Swiss franc. And right now this K-shaped performance has starts to revert back to the mean. So no longer K-shape, everything now is actually going back to the center line again. All right, so previous underperformance of the dollar against the Swiss franc and the dollar yen has starts to more or less be evaporated, at least from a short-term perspective. Previous outperformance of against the Aussie, the Kiwi, and as well as the Canada dollar has starts to actually revert back downwards as well. That means no longer up the upper K-shape. So the K-shape now starts to converge right now. All right, so this is the current intermarket fundamentals that is taking shape right now, with the US 2-year Treasury yield bouncing off from a key pivotal support level is not indicative of a tightening liquidity scenario, but however, in today's current context, is more indicating a normalization of the last 3 to 4 days of extreme risk-off behavior, and that may actually lead to what I call a short to medium term risk-on behavior in the markets. All right, so then the next key thing I share with you all is more related to the US stock market. So we know that this very popular chart which I share with you all as well. Okay, ignore these numbers over here. This is not updated. So based on this latest number as of 7th of August right now, we know that this ongoing risk-on behavior in the entire stock market is driven by AI optimism play, which is NVIDIA is leading the fort. Went almost as a high of 182% year-to-date return that was in June before it kickstart that dramatic corrective move. Still rather positive. Year to date is still hovering at a 3-digit figure of positive 116%. All right, return year to date, way surpassing the other major indices and the other major US stock indices, other global stock indices, and as well as the other mega cap technology stocks. So right now, let's have take a look at the intermarket relationship where NVIDIA could have a potential impact on the rest of the world in terms of this risk-on, risk-off behavior. So we know that Nasdaq is one of the key domino that triggered this major risk-off behavior in the last 3 to 4 days of session. And within Nasdaq 100, which particular component stock has the huge influence in its price movement? NVIDIA is one of them. So let's take a look at the chart of NVIDIA to see where are we doing. And from there, we could actually infer its intermarket dynamics relationship towards the other major US stock indices, especially on the Nasdaq 100. So we know that this is the current all-time high was on 20th of June, heading to a peak of 140.76 after the stock split. So you look at all in all, these 3 to 4 weeks of corrective decline that is being seen or inflicted on NVIDIA. Wait. Okay, let me do a proper one. Yeah, this is the one. Okay, so overall, it declined by 35%. All right, but what's interesting over here is that the key reversal, which is formed on Monday, managed to have a daily close right above this major ascending trend line that is in place since 13th of October. So if on that day itself, on that fateful day on Monday, if it didn't manage to actually have a daily close, it could trigger further potential sell-off based on those guys who use quantitative trading strategy, because it's a break of a major support level, which is 95.10, that could actually cascade to further risk of behavior across the market. Rather, the key reversal day that was formed on Monday on the Nasdaq 100 that kickstart this ongoing minor bounces that is being seen on the global stock indices right now. And what's interesting over here, from a technical perspective, right now potentially we could see a mean reversion bounce, at least in first step towards this resistance zone here at 117.13, 126.36. All right, this bunch of level here will also correspond to the 50-day and the 20-day moving average. Then I will put in into another aspect of the Elliott wave perspective. So based on the Elliott wave perspective, what we could see over here is a 5-wave down, 1, 2, 3, 4, 5. And if you were to look at the 5th wave target, all right, taking from the start of wave 1, the low of wave 4, putting up to the high of the low of wave 3, putting up to the high of wave 4, it actually correspond to the 0.76 fifth wave target exactly as well, give or take. All right, so FT in terms of Elliott wave principle, every after 5 wave that's formed and the low of the 5 wave hitting a standardized 5th wave target, which is 0.76, is one of them. Potentially we could start to see a ABC corrective rebound move. So that is a mean reversion rebound. Okay, but if you look, if we focus on the Elliott wave perspective, 1, 2, 3, 4, 5 wave down doesn't mean that is the bottom. It could lead to potential, after the ABC is being formed, another potential 5 wave down the road. All right, so there could still be some form of bullish or bearish pressure heading into the global markets if NVIDIA did indeed stage another 5 wave down after that mean reversion rebound has taken shape. So that means overall, in the next 3 weeks or so, is very crucial for the global markets. Why? Because we got to see how NVIDIA behave if the price action, when the price action hit this resistance zone over here, which is potentially the ABC corrective rebound inflection point as well. Okay, why do I say that? It confluence with a graphical resistance 117.13, 126.36, 20-day and 50-day moving average acting as resistance. And if you do the Fibo retracement target for the entire 5 wave down, it's also close to the 61.8% and the 76% retracement. So that is also a kind of a standardized ABC corrective rebound terminal zone in terms of the Elliott wave perspective. And what's interesting over here is that based on this current price movement, that means we're talking about 2 weeks or 3 weeks down the road over here, it could be coming towards close to the end of this month. And close to the end of this month, in fact, end of this month over here on the 29th of August, this is where we have a key risk event that is pertaining to NVIDIA, which is the release of its latest earnings result, the previous quarter earnings result on 29th of August 2024. All right, so notice that in terms of timing, everything seems to be aligned right now. But from a short-term perspective, potentially this ongoing normalization of that 3 to 4 weeks of risk-off behavior now transforming into a potential risk-on rebound behavior. That means we could at least in first step see a mean reversion rebound in the global stock indices. The key risk is when NVIDIA approach this key resistance level. We got to see how the intermarket correlation across the macro factors behave at this point in time, and also in light that should be very close ahead, coming close to the risk event that is pertaining to NVIDIA, which is the release of their previous quarter earnings, which is going to be at 29th of August. All right, so this is the current intermarket dynamics that I want to share with you all for today. Okay, so with that, now let us immediately jump straight into the short-term intraday technical outlook on the various cross asset classes, starting from the FX pair first. All right, so before that, now let me actually expand my screen so that you guys could actually have a better view on the chart in terms of the levels and trend. Okay, good. All right, so with that, let us now start with the FX market with the euro dollar. So if you could recall, euro dollar yesterday, we do have a bearish bias. Why? Because price action can't break above the medium term symmetrical triangle resistance that's being dotted by this gray line over here. So very quickly, let's go to the daily time frame chart. So this is what I mean. Okay, so previous rebound. Okay, notice that this close on Monday, the actually didn't surpass the upper limit of this symmetrical triangle rebound. So overall, what we could see over here, there could be a mean reversion decline back into the symmetrical triangle range resistance again, where the price action plays out as accordingly to our short-term intraday technical outlook yesterday, where we flipped to a bearish bias. So no change. We continue to actually expect a intraday bearish bias based on the current technical factors that is playing out on the euro dollar in a short-term basis. The hourly RSI continue to inch downwards below the 50 level, hasn't hit the oversold zone yet, so still indicating some form of short-term bearish momentum is still inherent in the euro dollar. So with that, we will have a tightened short-term pivotal resistance for today to maintain this intraday bearish bias on the euro dollar at 1.0965. That is actually close to yesterday's high, which is also very close to the upper limit of this symmetrical triangle as well. As long as price action didn't surpass 1.0965, maintain that short-term intraday bearish bias. Near-term support level to watch 1.095, 1.0870, which is close to the 20-day moving average. Below 1.0870 potentially exposes 1.0840 next. Only an hourly close above 1.0965 invalidate today's intraday bearish bias on the euro dollar to see a squeeze up to retest Monday's swing high area at 1.0990/1.10. Above it, may see the next near-term resistance zone coming in at 1.1060/1.1080 next. Moving on will be the sterling dollar. So the sterling dollar yesterday underperformed the euro dollar much more because it has a much more drastic fall and very clearly is trading within a short-term descending trend line or descending channel after the failure bullish breakout that was seen from the previous month of 12th of July and 17th of July, where it's reintegrate back into this dotted gray line again. So now it continued to actually evolve in this minor descending channel, and yesterday price action has really hit our support level as intended, which is close to the lower limit of the channel at around 1.2685. So with that, the RSI already now bouncing off from the oversold region at this point in time. So potentially there could be some form of minor bounce taking shape to actually retest the upper limit of this descending channel again, now acting as a key short-term pivotal resistance at 1.2790. So despite the fact that there's no clear signs of a bullish exhaustion at this point in time, we will still maintain that short-term intraday bearish bias on the sterling dollar as long as the bounce, this potential relief bounce or short-term bounce didn't surpass 1.2790 tighten key short-term pivotal resistance that we have for today on the sterling dollar. Next near-term support level to watch will be at 12660, which is so close to the lower limit of this minor descending channel, as well as the 200-day moving average, and as well as this congestion zone over here. A breakdown below 1.2660 exposes the minor swing low area in first step of 21st of June all the way down to 2nd of July, acting as the next near-term support level at 1.2620. Only an hourly close above 1.2790, that means the bounce get too swift and fast and break above 1.2790, that will invalidate today's intraday bearish bias to kickstart a mean reversion rebound to retrace certain portion of this ongoing minor decline to expose the next near-term resistance level in first step at 1.2890, which is also conversing with the 20-day moving average acting as a resistance. Above it sees the congestion area of 22nd of July and 24th of July acting as the next resistance at 1.2940 level. Okay, that's for the sterling dollar. Now moving on, next will be the Australia dollar. So that I recall, if you look at the daily chart of the Australia dollar, this is what I mean by the key reversal day that is being formed on Monday, right before the release of the latest RBA meeting outcome, which more or less reinforced the bullish reversal key reversal candlestick that was formed on Monday. So what we could see in the Australia dollar over here is that this bounce actually bounced off from a lower limit of a medium-term symmetrical, medium-term ascending trend line support that is in place since 13th of October 2023. So given this kind of what I call rather cautious stance that is being portrayed by RBA officials, still having a view that inflation pressure hasn't really subsided yet in Australia to convince RBA to kickstart a much earlier interest rate cut cycle, the Aussie dollar potentially could remain being supported within this messy range like scenario, all right, since from the start of 13 October 2023. That means there'll be got no clear trend, but it will be oscillate within this kind of very complex range scenario. Firstly, at the bottom is being supported by this rather cautionary stance of RBA officials not wanting to kickstart a interest rate cut cycle. Then on the top side, there could be another bout of risk-off behavior coming into play into the market that could potentially limit further upside on the Australian dollar. That means transforming it into a major uptrend phase. Okay, so that's the current takes right now. Now, with that, let us now focus on the short-term intraday technical outlook on the Australian dollar. So the Aussie dollar bounced as expected. So now hitting our almost coming close to our first resistance level that we highlighted yesterday. So no clear signs of bullish exhaustion yet. The RSI doesn't shape any bearish divergence at this point in time and continues to evolve in a series of higher low. Okay, over here. So with that, we'll have a tightened key short-term pivotal support for today to maintain that ongoing short-term intraday bullish bias on the Aussie dollar using yesterday's minor swing low that was being tested and rebounded at 64.70. So as long as this tightened 64.70 short-term pivotal support holds on the Aussie dollar, maintain that short-term intraday bullish bias above 65.80 potentially exposes 6610/6630, which confluence with the 20-day and the 50-day moving average that is acting as a resistance as well. And if we do the Fibo retracement of this entire swift decline all the way down to the Monday's key reversal low, that also correspond close to the 61.8% Fibo retracement level at the 6610, 6630 level. All right. However, if we start to see a breakdown with an hourly close below 64.70, that will actually invalidate today's intraday bearish bias to see a push down to retest 64.35, followed by 64 figure, and as well as the medium-term pivotal support level, which was the key reversal day low on Monday at 63.60/63.50 next. Moving on will be the dollar yen. So the dollar yen continues to shape the bounce as expected over here. So with that, we will have a kind of a tightened key short-term pivotal support level at 14350 level, 14350 level. So with this 14350 level, if you do a trend line support linking up to the current minor swing low, higher minor swing low that is in play, okay, pretty much close to this level as well. All right, so with that, as long as this tighten short-term pivotal support of 14350 holds, we'll still maintain this ongoing short-term intraday bullish bias of the dollar yen. Next resistance to look up for remains unchanged at 14850, followed by 151 figure, 15170. We also correspond to the 200-day moving average and as well as the upper limit of this descending channel that is still hasn't been taken out since the high of 11th of July. And only an hourly close below 14350 will invalidate today's intraday bullish bias on the dollar yen to see it shaping another impulsive down move to retest 14160/40. A break below it exposes 140.25, followed by 139 figures /138.10 next on the dollar yen. Now, with that, that sum up the intraday technical outlook on the major FX dollar pair. Now let us focus now on the major stock indices, starting with the Hong Kong 33 or the Hang Seng Index. So pretty much unchanged, the Hang Seng Index continues to hold above our short-term pivotal support level that we highlighted yesterday at 16,460 level. So still maintaining this 16,460 level as my short-term pivotal support level, maintaining that intraday bullish bias for that mean reversion rebound scenario to take shape to revert back towards the 200-day and the 20-day moving average, I think as a resistance. But it got to break above 16,970 to gain more crude traction, exposing the next near-term resistance at 17,185, followed by 17,410, 17,517. However, if price action come down and break below the 16,460, then it would actually invalidate today's intraday bullish buyers to see the start of another impulsive down move of its medium-term downtrend phase to continue to expose the next near-term support in first step at 16,130 slash 15,960 next. Okay, now moving on to the one of the major European stock index, which is the German 30 or the German DAX. So the German DAX continues to actually shape a series of higher low right above the short-term pivotal support that we highlighted yesterday at 17,030. So still no change, still using 17,030 as my short-term pivotal support level. RSI continues to shape that so-called bullish momentum scenario, where we start to see now a bullish breakout above this former parallel resistance over here and continues to shape a series of higher low. So net overall, some signs of short-term bullish momentum is still inherent in the German 30 or the German DAX. So with that, no change, still maintain that short-term intraday bullish bias. Next near-term resistance level to watch will be at 17,730 followed by 17,960. Only an hourly close below 17,030 will invalidate today's intraday bullish bias to expose the next near-term support level at 16,780 followed by 16,460 next. Now, moving on will be the major US stock indices, starting with the US Wall Street 30. So the US Wall Street 30 continued to bounce and hit our first resistance level at 39,190 before 39,480 before shipping that pullback during the later part of during the last 2 hours of the US session. And right now it's attempting to actually shape that bounce again. But given that it hasn't managed to broke above 39,480, what's this level? Because this level is also correspond to another key technical element, which is the 50-day moving average, I think as a resistance as well. So given that it hasn't really broken out 39,480, we will still maintain that short-term pivotal support level similar to yesterday's low, just in case of any wild whipsaw taking shape. First support level to watch will be at this level here, okay, at 38,920. All right, this is the first support level to watch. So right now, as long as the price action didn't break below 38,370 level, still short-term pivotal support, still maintain that intraday bullish bias on the US Wall Street 30. Above 39,480 sees the next resistance coming in at 39,840, and above it may see a further potential push up to retest the 20-day moving average that is acting as a resistance level at around the 40,380 mark over here. Only an hourly close back below 38,375 will invalidate today's intraday bullish bias on the US Wall Street 30 to kickstart another impulsive down leg of this ongoing medium-term corrective decline scenario. If this scenario really happens, means a break below 38,375 to expose the next near-term support area or supports level at 38,030, 37,760, and even 37,380 next in short term. Okay, now with that, let us move on to the Nasdaq 100. So the Nasdaq 100 going to bounce right above our short-term pivotal support level at 17,790. Yesterday there was a pullback attempting to actually break down, but managed to shape that bullish reversal candlestick on the intraday basis. That's the bullish hourly candle, and another test again on the start of today's Asia session before it shaped that bounce. All right, so indeed this is a key short-term pivotal support level that the bulls got to maintain in order to maintain this ongoing potential intraday bullish bias on the Nasdaq 100. Above 18,400 exposes 18,680 followed by 19,230, which also confluence with the 20-day and the 50-day moving average acting as a resistance level, similar resistance level as well. So with that, as long as 17,790 short-term pivotal support holds for today, we will still maintain that short-term intraday bullish bias on the Nasdaq 100. But however, a breakdown of the hourly close below 17,790, then this intraday bullish bias will be invalidated or negated to see a retest at the key reversal day low at 17,400 slash 17,310. A break below it, kickstart another round of impulsive down move to expose the next near-term support level in first step on the intraday basis at 17,160, 16,930, followed by 16,600 next. All right, so that sum up the intraday technical outlook on the major stock indices. Now let us focus our attention now to the commodities market, starting with gold XAU/USD. So still recall in gold XAU/USD, based on yesterday's price prior day price movement, gold seems to be that now is trading within a symmetrical triangle, a minor symmetrical triangle range configuration ever since the all-time high of 17th of July, depicted by this dotted purple line over here. So yesterday it attempts to actually trade down, but didn't surpass below the low of the symmetrical triangle range configuration, which was our short-term pivotal support that we highlighted yesterday as well at 2,377. So using 2,377 as my short-term pivotal support, still maintain that intraday bullish bias within this symmetrical triangle minor range configuration that is playing out. Resistance level to watch in first step will be at 2,415 level. Okay, let me put it over here. 15. We also correspond to the 20-day moving average acting as a resistance as well. Only a clear break above this level potentially may see a further potential push up towards the upper limit of this symmetrical triangle range at the resistance zone of 2,456/2,470. But however, if price action fails to actually evolve towards the upper limit of the symmetrical triangle and starts to shape a breakdown with an hourly close below 2,377, then it will kind of trigger off a bearish breakdown below its range to expose the next near-term support level at 2,353, followed by 2,336 in the first step. All right, so that's for gold XAU/USD. Lastly will be West Texas crude oil. So West Texas crude oil, yesterday we do have a bullish bias for the potential mean reversion rebounds to take shape as well. No change, still using that short-term pivotal support level here at 73.15/72.24. So as long as this level holds, the next near term still maintain that short-term intraday bullish bias on West Texas oil. Near-term resistance level to watch on the intraday basis 75.46, followed by 77.22. Only hourly close below 72.24 means a breakdown below this Monday low will continue the medium term downtrend movement or motion to expose the next near term support level at 71.35, followed by 70.40 next. So 70.40 is actually way back over here, the swing low area of 2nd of January to 18th of January this year. Right, so that sum up today's intraday technical outlook on the major cross asset classes. So before we go, let's have a quick look at the economic calendar to see what are the key so-called data to look out for today. All right, so over here, what we could see is that the next data to look out for during the European session, when the European session open, is rather quiet, except for one of the key Eurozone economy, which is Germany. At 2 p.m., it will release its industrial production for the month of June. So something to be aware of, because it also potentially could impact the German DAX movement. And going forward, over here is rather quiet. Okay, except for one that's related to the West Texas crude oil, which the US EIA weekly crude oil stockpile change that will be released at 10:30 p.m. Singapore time. Okay, and thereafter, nothing pretty much interesting to actually take note of the economic calendar. All right, so with that, do have a great day ahead. And this is Kelvin here signing off, and we shall speak again tomorrow. Thank you.